This is Module 2 of Accounting 3110, and today's subject is going to be the cost terminology that is associated with the branch of accounting called management accounting. It'll be interesting as we try to better understand the terms that are associated with this area of accounting. At the same time, we'll be bringing up some of the issues, the fundamental issues and concepts that relate so strongly to this area of accounting. As we begin to look at various cost terms, let me define cost as it is defined in your textbook. A cost represents resources given up to achieve a certain purpose. And as we learn various cost terms, they can become quite confusing because it seems like there appears to be a lot of overlap, and this can create some confusion for the learner. And I think this confusion probably comes from the fact that we can have just one cost item, and yet that one cost be given a multitude of different names or different terms associated with that cost. Let me give you an example, an accounting cost term that could be described in numerous ways. For example, let's take the wood that is used in the manufacturing of let's say a wooden desk. That direct material wood could be described as a variable cost, a product cost, a direct cost, a non-discretionary cost, a prime cost, an inventoriable cost, a unit level cost, and even a controllable cost. So I'm taking one cost item and describing it using all these terms. As an analogy, let's take perhaps a student, an ETSU, maybe a female student. And this student could be described as someone's daughter, someone's sister, someone's neighbor, someone's classmate, someone's coworker, someone's student. And yet we're talking about one student. So this is what we want to keep in mind as we discuss various terms, that we really have to look at the context and what problem or issue that we're trying to figure out. And once we know the area that we want to discuss or the context, then we can talk about what terms would be appropriate to that context. For example, issue number 1. When a firm manufactures a product or products, some of the costs will actually attach to the product and become part of that unit's cost. In other words, some of these costs become inventoriable and they attach to the product. We know that the product is an asset, or it's called inventory on the balance sheet, until it is sold, at which time it becomes an expense called cost of goods sold. So the issue becomes which costs are going to attach like that to the product, and then there are going to be other costs that are simply going to be expensed immediately as they are incurred. So when we're looking at this issue, which ones attach to the product and which don't, we bring up two terms: product cost versus period cost. A product cost will include all costs incurred to manufacture the product. These would be called inventoriable cost. Period costs represent those costs that do not attach to the product. They're non-inventoriable, and period costs are expensed immediately. Let's take a look at a basic income statement where we have sales minus cost of goods sold equals gross profit minus SG&A expenses equals net income. What we're saying is that it's important to know the difference between a product cost and a period cost, because we would be able to determine where to find these costs on our income statement. Product cost relate to cost of goods sold. Period cost are essentially our SG&A expenses. So when we look at product and period cost, we can actually think of it in a physical sense, where if we have a manufacturing facility, the costs that occur in the facility, these costs to produce the product are going to be our period cost. And those costs that occur outside the facility, maybe over here at the corporate office, these costs would be our period costs. So where the costs occur can direct us toward determining whether a cost is a period or a product cost. Let's think of this too in terms of stages. A product cost is really going to go through 2 stages. Product cost attached to the product and become part of the inventory or the asset for the firm, and then will become an expense called cost of goods sold at the point units are sold. So product costs start out as part of the asset value. This is the account called inventory, and end up later being expensed. When we talk about the period cost, this is a one-stage situation where these costs are expensed immediately. So SG&A costs do not get carried as part of the value of inventory, but in the period in which those costs are incurred, period costs immediately are reported on the company's income statement. Let's go back to that. So when I put SG&A expenses on this month's income statement, I know that these costs were incurred this period and are being expensed now. Let's take a look at 5 costs, and we'll talk about whether we would think they would be period or product or period costs. The machine operator's wages. This cost occurs in the manufacturing facility. It is a cost of producing the product. This is a product cost. The corporate office secretary's salary, again, if you think in physical terms, this cost would be occurring here. This would definitely be a period cost. The factory custodian would be back in the manufacturing facility. This would be another product cost. This is a support function, but is part of the cost of producing the product, and the cost did occur in the manufacturing environment. The cost of raw materials, of course, would be a product cost. And shipping cost would be considered SG&A or a period cost. Distribution costs have nothing to do with production, so anything related to distribution is going to always be expensed immediately, considered to be a period cost. To help us get more familiar with terms, let's go to another issue that would be important to us as management accountants. The second issue has to do with the traceability of cost. Can a cost be traced to some specific cost object? For example, the cost object might be a department, it might be a product. So for example, when we talk about a certain cost that relates to production, can that cost be traced directly to the product, with the product being considered the cost object? So the 2 terms that relate to this discussion or relate to this issue would be the terms direct and indirect. A direct cost can be traced to a cost object, which let's use, for example, the product. If we have individuals who work on the product, for example, we're making those wooden desks and they're actually constructing or building the desk, this would be considered direct labor, because every hour they're working, they could trace to that that product. We were working on the product for 6 hours or whatever, but you can trace it. An indirect type of labor would be perhaps a supervisor who works in a facility where they're making multiple products, and maybe the supervisor is checking all the different products. And so you really couldn't trace his salary to one product, but his salary would have to be allocated among all the products. So what we see about indirect cost is that they are also called common cost because they can't be traced to just one cost object. And indirect costs create a lot of work for management accountants because they must be allocated. And as you will see throughout the course, this becomes a subject in many of our modules. Let's take an example now of the words direct or indirect. If we have an ETSU custodian, Mrs. X, and Mrs. X works only in Sam Wilson Hall, but she works all over the building. She cleans in accountancy's offices, economics offices, and so forth. If we ask whether Mrs. X's salary is a direct or indirect cost, that cannot be answered until we define the cost object. So if I define the cost object to be the College of Business, then her salary would be a direct cost. You can trace it to the College of Business because she only works in Sam Wilson Hall. If I chose the Department of Accountancy as the cost object, then I would have to answer that her salary is an indirect cost. What would happen is that her salary would have to be shared among all the departments, accountancy, economics, marketing, and so forth. In other words, her salary would be indirect and have to be allocated. Let's look at a third issue again, just trying to bring forth these issues so we can put these words into some context. The issue here is, how do costs change when activity level changes? In other words, if we're talking about car insurance, what happens to the cost of car insurance when you drive more miles? What happens to the cost of gasoline for the month when you drive more miles? So we're talking about what happens when we get busier or less busy. What happens in terms of the change in cost? This brings about terms such as variable cost, fixed cost, and the hybrid in between the two, which is called a mixed cost. We can discuss the terms direct and indirect too in terms of materials. We're going to have what we call direct materials, and these are the materials that we actually keep track of exactly how much we use. We use this many board feet, or this many gallons, or this many pounds. We also have materials that it's really not economically feasible and unreasonable as well to try to keep track of how much we use of these materials. For example, if we're putting staples in the desk, or we're hammering in small nails, or those kinds of things, it may not make sense to try to count how many staples we put in every desk. So if we don't keep track of them and trace them, then they become what we call indirect materials. So we have direct materials, indirect materials. We have direct labor, where the labor is used to actually make the product, and then we have the indirect labor, where labor is used in more support functions but not in the making of the product. So again, this is all about traceability. This is a graph of an example of fixed cost, and on the y-axis you see the total cost, and then across the x-axis we see units produced. And according to this visual, as we produce more product, In other words, as the activity level increases, the cost remains the same. Fixed costs are expressed in total. So this is total per period equals $150,000. Even though we express it typically in total for a certain period, we can also compute fixed cost per unit. And a very important concept here is that if we have $150,000 of cost, as we move toward more and more units produced, the fixed cost per unit will drop and drop and drop as we move to higher levels of activity. Let's look at a graph of the variable costs. And the variable costs are typically expressed on a per unit basis. This is an example of a $10 fixed cost, or excuse me, a $10 variable cost. And you notice again, the typical expression is so much per unit or per hour. It's going to be expressed this way, but it doesn't mean we can't express it in total cost. For example, if I looked at 3,000 units, then my total cost is $30,000. If I'm producing 5,000 units, then my total cost is $50,000 because each unit has a cost of $10. Now, you can always recognize a variable cost due to the slope of the line, but particularly because when you have zero level of activity, no units being produced, you will also have no cost. So that the slope of the line remains constant. So regardless of what level we're at, the $10 per unit is going to remain constant. Now, I do want to add that at some point, if we're looking at fixed cost or variable cost, when we get further out here to the right, we are going to move out of the relevant range and we will see a change in cost. Perhaps fixed will go to a higher level. The same way with the variable cost, that at some point that slope of that line may change. It may start going down or it may start going up. But when the costs change, this is when we say we have moved out of the relevant range. Let's take a look now at those 5 costs we looked at earlier where we define them as being product or period, and let's define them now in terms of their cost behavior. Machine operator's wages would be a variable cost. This person's getting paid X amount per hour. The corporate office secretary's salary is a fixed cost. It's the same each period. The factory custodian earns wages, and if the production facility were to be shut down, he would not be earning any wages or any pay. So this is a variable cost expressed so much per hour. The cost of raw materials. Raw materials would be considered a variable cost because, again, it's so much per unit. If we're not producing, we don't have that cost. And finally, shipping costs are variable, and these will vary as a function of the number of units that we ship. So again, it'll be so much per unit shipped. The fourth issue that we can consider is whether certain costs can be avoided or reduced or changed. If we have costs where we are committed, these are called committed or non-discretionary cost. What that means is we are under some kind of contract or lease where we really can't change the amount of cost we're incurring. If a cost is discretionary, this means that we can avoid it or reduce it. And a good example of a discretionary cost would be advertising cost. We can avoid it for a month, or we can reduce it or increase it, but it would be at our discretion. Finally, as we look at a final issue, this issue number 5 has to do with whether a cost can be controlled by a particular manager. And when we deal with this issue, we are talking about what we'll call controllable or uncontrollable cost. And when we use these terms, it seems very similar to issue 4, where we talked about committed and discretionary. But when we talk about this, we're talking about being controllable by a particular manager, whether he can make a difference or not. So the terms controllable or uncontrollable are always used in the context of a particular manager, whether this person has the ability to change that cost or if it's something that is out of his ability to control. Finally, there are 2 or 3 other additional terms that I'd like to explain to you. The first being the term opportunity cost. Opportunity cost is the cost of what you have sacrificed. For example, a person going back and getting a second degree after they have one college degree. That second degree is very costly because during the time they're getting the second degree, they could have been in the workplace earning a salary. So this gives you an example of what we mean by opportunity cost. In financial accounting, we do not really use opportunity cost in any of our reporting, but you will see it as a subject matter in management accounting. Another type of cost we will call sunk cost, and sunk costs are simply past cost related to past decisions. And the thing that's important to talk about with sunk cost is that they're really never relevant for decision making when we're trying to make a decision for the future, because they are indeed past cost and there's nothing we can do about them. So they become irrelevant in future decisions. In conclusion here, as we finish up this module relating to all the terms that are very common in management accounting, I think it's important to go back to something that we talked about in Module 1, and that is, in the role of a management accountant, we want to better understand cost, we want to do a better job of measuring cost, we want to do a better job of minimizing cost when we can, and when we can't, when we're committed to certain costs, we want to be able to maximize the benefit that we get from that cost incurrence. So I think it's very helpful, and we'll close with this today, to think of cost in terms of the level at which they are incurred. And according to your textbook, we have what is called a cost hierarchy, and it's worth working through one example using such a hierarchy. Let's take an example of a company that has done a lot of research to come up with a new soft drink, or not a soft drink, but a sports drink that maybe is loaded with all kinds of good vitamins. The company that produces this drink is going to have cost occurring at the unit level, batch, product, customer, and facility level. So let me give you an example of this sports drink example of how we would determine whether a cost is unit level or batch, product, etc. An example of a unit level cost would be the materials that go into making that sports drink. So the actual ingredients would be a unit level cost. Every bottle of the sports drink would incur that cost. A batch level might be the cost to set up the machine to make a batch of this type of sports drink. So the machine set up to run a batch would be a batch level cost. All the research and development that had to be done ahead of time before this drink could be manufactured would be a product level. So these costs at this level of the hierarchy relate to a product line. Customer level costs relate to specific costs that are incurred in dealing with specific customers. For example, if we're going to sell a lot of these sports drinks to perhaps Walmart, then costs that we incur to deal with Walmart as our customer would be considered customer level cost. And finally, every organization has what we would call infrastructure cost, facility level costs that don't directly relate to the products that we make or sell, but are necessary just to carry on the business. And this would be things like depreciation on our building, taxes on and insurance, and other issues like that that are absolutely part of being in business. This is the conclusion of our discussion today on cost terminology. And again, keep in mind that the purpose of today's module was to introduce you to these terms and these issues and concepts. This doesn't mean we won't see them again, because as we move through the various modules, you will be reminded of this module where we first introduce these concepts. And I hope that you will return again to this module as you proceed through the class to make sure that you have a clear understanding of the terminology.